I'll talk about I'll actually talk about 4 different things on why a trading entity is going to make sense. Number 1 is audit protection. Then we'll talk about retroactive mark-to-market election filing, which, you know, if you filed your taxes already this year but you did not elect mark-to-market and it's something that you want to do, an entity can give you kind of a do-over, and we'll talk about how that happens. If you're a part-time trader, or if you have you know, significant W-2 income or another business, a trading entity is going to strengthen your case for trader status. And also more tax deductions. And again, you know, getting into retirement plans and getting into health insurance, you need to generate earned income. You know, if trading is your only business and your wife or your spouse, I should say, does not work, and you are trading for a living and you don't have an entity, then you don't have earned income and you're not able to take advantage of retirement plans, IRAs, you know, single 401k plans, or health insurance deductions. So an entity can help create that earned income that the IRS looks for, so that you're able to take advantage of those deductions. So let's look at the first thing there, which is audit protection. And I get asked this, you know, quite a bit. You know, if I'm filing a Schedule C, you know, as the default method for a trader, what ends up happening is that all of your losses go on your Schedule C. So you could have, you know, if you're a big enough trader, you could be generating some significant gains on your Schedule Ds or you know, or your Form 6781 for your futures business, but you could have significant losses that are showing up on this Schedule C. And so a lot of people are concerned about that, and they're concerned about getting audited by the IRS because of that. You know, they're not pulling any income on that Schedule C. So just looking at the statistics, it shows that what the IRS really goes after is sole proprietors. I mean, they look at Schedule C businesses. Those are the ones that get audited the most. And if you look at the percentages, in 2008, 1 out of 100 tax returns overall got audited in 2008. But looking at Schedule Cs and drilling down on sole proprietors, if you have Schedule Cs that are generating under $100,000 in income, they're 400% more likely to get audited than a partnership return or an LLC or an S Corp. You can see when the income goes up over $100,000, Schedule Cs get 1,400% more likely to get audited than partnerships, LLCs, or S Corps. So again, going that route of a partnership, an LLC, or an S Corp, you dramatically reduce your odds of winding up under audit. Majority of trader status cases that go to tax court are filed as sole proprietorships on Schedule Cs, and there are cases out there that have gone, but there's very few that end up going to tax court for an entity that files a separate tax return. So those are just some of the statistics that I've come across. Let's look at a retroactive mark-to-market filing. So, you know, we talked about mark-to-market earlier, but, you know, let's say you've already filed your tax return this year and you wanted to make the election, but you weren't sure about it, or you just didn't get around to doing it, or what have you. Well, it needs to be filed with that tax form, but if you missed it, what you can end up doing is forming an entity, and then you have 75 days from the date that you form that entity to make the mark-to-market election. You know, otherwise you're going to have to wait till you file your taxes next year to make the election. So let's look at an example here. Let's say you have a trader who filed their 2010 personal return on February 15th. In March, you know, they decided that they really wanted to make that election this year. So March 1st, they form an entity, and they make the election for the remainder of 2011. So what happens on their taxes for 2011 is they'll fill out a Schedule C and get taxed as a sole proprietor on the cash basis from January 1st to February 28th, you know, that time frame, and that goes on the Schedule D, and the expenses would go on the Schedule C. And then they're going to get taxed as an entity with mark-to-market from March 1st to the end of the year, and that again would go on Form 4797. So you'd have a split basis, and that can be that way whether you could decide that you wanted to file mark-to-market in June of this year, and it would be the same case, same type as this example. January through June 1st, you would be treated as a sole proprietor, cash basis, and then from June 1st to the end of the year, you would be treated as an entity with mark-to-market. So you'd have a couple different things to do for next year on your taxes. The other thing an entity does is it actually gives you the ability to revoke your mark-to-market. If you're a sole proprietor trader and you've made the mark-to-market election, you've got to write in and request permission from the IRS to revoke the mark-to-market. And I can tell you that it's very, very difficult to do that. The reason that you're going to do it, obviously, is it makes the most sense in your favor, and the IRS knows that, so they're not very likely to allow you to do so. However, if you're inside of an entity, that entity can actually close down and cease to exist, and then your trading business would revert back to being a sole proprietor on a cash basis going forward. And you can always form another entity down the road and elect mark-to-market again, but the entity is going to give you that flexibility to revoke your mark-to-market if it's something that you wanted to do down the road. I see this quite a bit. I mean, I do see part-time traders. You've got traders that might have part-time or full-time jobs, or they're a consulting business, or they've got a spouse who's got significant income, or they have other self-employment earnings. Being supported in any other way other than active trading, spouse's income, etc. I would always encourage you to establish an entity in this situation, and the reason being is, if you remember, one of the requirements that the IRS looks for is that you're trading to earn a living, and if they see significant income coming from other sources outside of that, they could bust your trader status. Forming an entity is going to shield you from this, because what will happen is the trading entity is actually going to be considered a trader, because 100% of its activities is centered around trading, and 100% of its capital is employed in an active business of trading. So if you find yourself in that situation where you are working part-time, or you've got a spouse who maybe has a nice income coming in, et cetera, then an entity is going to make a whole heck of a lot of sense to help solidify your trader status. And the final thing, excuse me, the final thing about forming an entity is you get more tax deductions. You get potential for retirement plans, IRAs, solo 401k, SEP plans. To be able to contribute to these, you have to have earned income, and trading gains. From the IRS's standpoint, trading gains are not considered earned income. Whether you've elected mark-to-market accounting or whether you're still on a cash basis, it's not considered earned income. So having an entity, what that enables you to do is to pay out a administration fee, which would go on a Schedule C, and you'd pay self-employment tax, but again, that generates earned income. And that enables you to be able to fund an IRA or fund an individual 401k, these other types of retirement plans. It also gives you the same thing with health insurance. You can deduct 100% of your health insurance premiums, partnerships, or LLC members, and single owner S-corps. One thing I would caution you, though, and I've seen some mistakes made in this avenue, is that it's, if you're an owner or a member of the LLC, or a partner in that partnership, or the as I said, the owner of that S-corp business, the health insurance premiums are not a business expense. It's a business expense if you've got employees, but as the owner of that business, it's not a business expense from the IRS's standpoint. So it goes, actually that expense shows up on your 1040 on the front page, I believe, and don't hold me to this, but I believe it is line 29 is where you take that business expense for your health insurance deductions. Some cautions: you must not be eligible to participate in another health plan at another job or through your spouse's work. So if your spouse works and they are offered health insurance coverage from that other job, you can't take it. You can't take the deduction for your health insurance. Also, the deduction cannot be greater than the income of your business. So again, getting back into the earned income aspect of it, you generating the earned income on that Schedule C is going to open up the health insurance deduction for you. Otherwise, it has to go on your Schedule A under medical expenses, and it's subject to the 7.5% of your AGI floor. So that eliminates a lot of deductions for high net or high income earners from that standpoint. Health insurance deductions, sole proprietor traders have no earned income. As I talked about before, entities, and this is kind of a review of what I mentioned here earlier, but entities can pay out an administration fee, and it's claimed on the Schedule C. So what you can do as a sole proprietor, I'm trying to think if I covered it here, but as a sole proprietor, you can actually, and let's say that you haven't formed that entity yet, the solution here for your sole proprietor is you pay your spouse a fee, but the requirement is that he or she is going to have to be active in your trading business. You can't just pay them a fee for nothing. But if they are active, reconciling trades, helping with research, what have you, then paying them the fee you can do, and that opens up again the retirement plans and health insurance for the sole proprietor. So there are ways around it. You just gotta know how to do it. Just a quick thing on self-employment taxes. I do get asked this quite a bit too. I mentioned this earlier, but traders are exempt from self-employment taxes unless you pay out that administration fee. So if this, again, does not matter if you've elected mark-to-market or not. IRS Pub 550. And this is right out of that publication. Gains and losses from selling securities as part of a trading business are not subject to self-employment tax. So again, it doesn't matter if you've elected mark-to-market or if you're a cash basis trader. Your trading gains are not subject to self-employment taxes. There's actually two ways that there's two groups of people that would be subject to self-employment taxes, and that is if you are a proprietary trader. So if you work on a prop desk and you get a 1099 miscellaneous, you are subject to self-employment tax. Or if you're a dealer or a member of an options or futures exchange, you are subject to the self-employment tax. So other than that, if you do not fall into those two categories, your trading gains are not subject to self-employment taxation. So let's look at the different types of entities for traders. We'll start out with the sole proprietor, and this is the default method for traders. So if you started to classify yourself as a trader in the IRS's eyes, this is what you would be filed as unless you've incorporated. You'll be filed as a sole proprietor. It's the least expensive to set up and maintain. It's the default method, as I mentioned, for traders. All of your expenses go on Schedule C. Your income is going to go on Schedule D or on Form 4797 if you've elected mark-to-market. And the problem, again, is getting into is there's no earned income. So on your Schedule C, if you're showing nothing but losses on your Schedule C, you're not able to take Section 179 expenses. So if you've bought computer equipment and you wanted a Section 179 expense, in other words, take all of that expense up front, you're not able to do that because you're not showing any income on your Schedule C. Home office deductions, same thing, because you don't have earned income. On that Schedule C, you're not able to take that home office deduction. And then retirement plans and health insurance, as I talked about earlier. One of the simple solutions to overcome the home office deduction and the Section 179 expenses for sole proprietors is that we actually, at Shrink My Taxes, we actually will transfer just enough income over to the Schedule C from the Schedule D, and we make notations for the IRS for this because it does not change your tax consequence at one iota. But what we do is we'll transfer some of the income that you've got from trading gains over to your Schedule C so that we can open up the home office deduction, and we open up the Section 179 deductions for traders. So that's something that we do over here, and it enables you to take those deductions. The net effect is there's zero effect on your taxes as a result of that. So that's how we've come up with a solution for that. As far as retirement plans, I mentioned this a few slides ago. For retirement plans, health insurance, as a sole proprietor, you can't pay yourself a management fee, but you can pay your spouse, an administration fee, and that'll open up retirement plans for both you and your spouse if you're able to pay over enough. So looking at an example of what I'm talking about, I always like to put things in numbers so you can kind of get a feel for how these things work. Let's say we've got a sole proprietor trader who's 50 years old, has got $75,000 in net trading gains for the year. If they do nothing, and this is $75,000 net of exemptions and other deductions and things like that. I'm just going to look purely at the trading income. Doing nothing, they're going to owe. If it's all short-term, they're going to owe $11,125 in taxes for the year. If they pay $13,000 out to the spouse for administration work, then what happens is they will owe the spouse on that Schedule C, claims $13,000 in income. They'll owe $1,976 in self-employment taxes. But what it does is that creates enough income that they can take the $12,000 IRA deduction. That's the $5,000 deduction plus the $1,000 catch-up for both husband and wife. Now the effect of this is that they owe, after the IRA deduction, they're going to owe $8,466 in federal taxes. If you add the self-employment taxes on top of that, the total tax bill came to $10,442, which is a savings of approximately $700. But what we've also done is put $12,000 into an IRA, which is going to grow tax deferred and be shielded from taxes going forward until they pull the money out down the road. So you can get a feel that how you can work this and save yourself some taxes, but also be able to contribute to that IRA. Husband-wife partnerships. That's the if you are married, this is the preferred way to go over an LLC or an S corp. Reason being is that they're very inexpensive to form and maintain. Definitely get an EIN number, which is an employer identification number. Definitely get that because it's establishing the fact that this is a formal business. Partnerships actually happen automatically whenever two or more people go into business together. So if you've got joint accounts and you're trading a joint account, you could be deemed as having a husband-wife partnership. So just something to keep in mind. Partnerships file their taxes on Form 1065, and it's really an informational return. And it's due April 15th, not March 15th. And the nice thing about partnerships is that the profits and losses flow through to the individual tax return, and they'll come over on a schedule or a K1, and they'll show up on a Schedule E on your individual tax return. So it's definitely a pass-through entity, and so if you've got losses and you're generating losses in your trading business, you'll be able to take those losses on your personal return, which is a great thing. It also, you're able to pay yourself an administration fee as opposed to having to pay your spouse. So you can go ahead and pay yourself. And again, it's the same, the same concept. It goes on a Schedule C. You'll owe self-employment taxes on it, but it opens up health insurance. It opens up retirement plans and things like that you're able to take. Your spouse can be active or passive in your partnership. And just a word of caution: if your spouse is not active, if they are passive, and they don't really contribute to your trading business, then they should be no more than a 10% owner due to the passive loss limitations that are taken there. So make them a 10% owner if they're passive. That would be my recommendation. The next type of corporation that makes sense for traders is limited liability corps. These are a little more expensive to set up and maintain than a husband-wife partnership, and you're going to start to see a few more fees starting to creep in here. As well, and as well as you know, more things that you have to do throughout the year for your corporation. So we're kind of moving up the scale, if you will, in the way I've laid this out. They're a little bit more expensive to set up and maintain, as I talked about, than partnerships. You've got state registration fees, and you're going to have annual state filing fees, and you'll have minimum state taxes. California has a minimum franchise tax for LLCs of $800. They do not have that for partnerships. A husband-wife partnership in California is considered a general partnership, so it's not subject to that $800 franchise fee. But limited partnerships are subject to that out in California, but husband-wife partnerships are general partnerships, so they're not subject to that. LLCs, like a partnership, is filed on Form 1065, or LLCs, you can actually elect to treat it as an S-Corp, which only makes sense for single-member LLCs, which I'll talk about here in a second. Most of the time, your LLCs, which are default taxation, is going to be a partnership, and that form, again, is due 4/15. Profit and loss is passed through, which is what we want in our trading entity. We want everything to pass through to the individual tax return, and just like the partnership return, it shows up on a K-1 and it shows up on our Schedule E. Now, limited liability corps compared to S corps and C corps, they're easier to set up, and they're easier to set up and maintain, and there is less paperwork and record keeping versus an S corp or a C corp. There's no requirement in most states for annual general shareholder meetings, which you have to have for S corps and C corps. And earned income. We can generate earned income same way, administration fees paid out and reported on our individual Schedule Cs. Single-member LLCs, you may have heard this term before. It's a disregarded entity by the IRS, and really, what does that mean if you're not familiar with what happened? There were court cases that they were able to pierce the corporate veil, if you will, for single-member LLCs. So that's why they're called disregarded entities by the IRS. It's really a know-nothing entity in the eyes of the IRS. It is taxed as a sole proprietor on a Schedule C. So if you've got a single-member LLC and you haven't done anything as far as making an election to be taxed as a corporation, it's taxed as a sole proprietor on your Schedule C. So there's no entity protection as far as creditors are concerned, and you know, again, you're going to fall to the same situations as we talked about with sole proprietors on how to try to establish earned income. You're going to run against the same types of hurdles, if you will. Single traders can use single-member LLCs, but elect to be taxed as an S-Corp. And you'll need to file Form 8832, which is an entity classification election, and file Form 2553 to be taxed as an S-Corp. So those are the two things that you need to do if you're a single trader. You can actually set up a single-member LLC. It makes sense for single traders because it is easier to maintain than a regular S-Corp, but you can elect to be taxed as an S-Corp, which is what we encourage all single traders to do.